Welcome back, rich followers. Today we're diving into the sensational story of Archegos Capital, the $20 billion margin call that shook Wall Street to its core. You might be thinking, how could one firm's downfall send shockwaves across the global financial system? Well, it all started with Archegos Capital's aggressive use of leverage and complex financial instruments. Archegos Capital, a family office run by former hedge fund manager Bill Hwang, was heavily invested in a few high-flying stocks. To amplify their bets, they used an enormous amount of borrowed money, also known as leverage. But they didn't stop there. They also utilized complex financial instruments called total return swaps, which allowed them to make massive bets on stocks without actually owning them. Now, you might be wondering why anyone would take on such massive risk. Well, the answer lies in the potential rewards. You see, when you use leverage, your gains are magnified, and in the world of high finance, fortune favors the bold. For a while, everything seemed to be going great for Archegos Capital, as their bets on high-flying stocks paid off handsomely. Little did they know, this strategy would soon come back to haunt them. Part 2. The rapid growth of Archegos Capital leading to massive exposure in concentrated positions. Archegos Capital, a family office founded by Bill Hwang, started as a relatively modest investment firm. However, over time, it experienced exponential growth, amassing billions of dollars in assets under management. This rapid expansion was primarily driven by the firm's aggressive investment strategy, which involved taking on massive exposure in concentrated positions. At the heart of Archegos Capital's strategy was the use of leverage. The firm borrowed heavily to amplify its bets on a small number of high-flying stocks, such as Viacom CBSA, Discovery Communications, and a few Chinese tech giants. This approach allowed Archegos to significantly magnify its gains during periods of strong market performance, further fueling its growth. However, this aggressive strategy came with significant risks. By concentrating their investments in a few stocks, Archegos Capital was highly vulnerable to market fluctuations and the performance of individual companies. This lack of diversification meant that any negative news or events affecting their concentrated positions could have a disproportionately large impact on their portfolio. Archegos also utilized complex financial instruments, such as total return swaps, to maintain its large positions. These instruments allowed the firm to bet on the price movements of stocks without actually owning the shares, effectively concealing the extent of its exposure. This lack of transparency made it difficult for regulators and counterparties to fully understand the scope of the risk involved. This dangerous combination of high-leverage concentrated positions and complex financial instruments set the stage for Archegos Capital's ultimate collapse. When Viacom announced a stock offering, its share price plummeted, triggering a margin call that Archegos couldn't meet. This forced the firm's prime brokers to liquidate its positions, further driving down the prices of the affected stocks and exacerbating the losses. The unraveling of Archegos Capital serves as a stark reminder of the perils of excessive risk-taking and lack of diversification in investing. The firm's meteoric rise was fueled by its aggressive strategy and massive exposure in concentrated positions, but it was this very same approach that led to its catastrophic downfall. This cautionary tale highlights the importance of maintaining a balanced and diversified portfolio, understanding the risks associated with leverage, and ensuring transparency in financial dealings to protect against unexpected market events. Part 3. The downfall begins. Viacom's stock offering triggers a massive margin call. The beginning of the end for Archegos Capital started with a seemingly innocuous event: Viacom's announcement of a stock offering. The media giant was looking to raise capital by selling additional shares to investors. While such events are relatively common, the impact of this particular stock offering would send shockwaves through Wall Street and ultimately lead to Archegos Capital's dramatic collapse. As soon as the news broke, Viacom's stock price began to tumble. Investors, concerned about the dilution of their holdings and the company's future prospects, started to sell their shares. The rapid decline in the stock price caught Archegos Capital, with its highly leveraged and concentrated position in Viacom, off guard. As the stock price fell, Archegos Capital found itself on the wrong side of a massive margin call. Margin calls occur when the value of a leveraged investment drops below a certain level, prompting lenders to demand additional collateral to cover their potential losses. In Archegos' case, the plummeting value of Viacom stock meant that the firm no longer had enough collateral to satisfy the requirements of its lenders. Unable to meet the margin call, Archegos Capital was forced into a corner. The firm's prime brokers, which included major financial institutions such as Goldman Sachs, Morgan Stanley, and Credit Suisse, started to liquidate the company's positions in a desperate attempt to recover their loans. This involved selling massive quantities of Viacom, Discovery Communications, and other stocks held by Archegos. As the brokers scrambled to unload the stocks, the already weakened share prices were driven down even further. This created a vicious cycle where the falling stock prices triggered additional margin calls, leading to more selling and further declines. In a matter of days, the situation spiraled out of control, ultimately wiping out Archegos Capital and leaving its lenders with billions of dollars in losses. If you're getting value from this video, please drop a like and leave a comment about how I can improve. Now back to the video. The downfall of Archegos Capital, triggered by Viacom's stock offering, serves as a stark reminder of how quickly fortunes can change in the world of finance. The massive margin call that ensued exposed the fragility of Archegos' highly leveraged and concentrated investment strategy. It also highlights the importance of understanding and managing risk, as well as the potential consequences of opaque financial dealings. Part 4. The domino effect. Forced liquidation of Archegos positions causes major losses for global banks. As Archegos Capital failed to meet the margin call, their brokers began a forced liquidation of the firm's positions. This massive selling spree sent the prices of the affected stocks plummeting, causing significant losses for global banks, including Credit Suisse and Nomura, which were left holding the bag. The impact of Archegos Capital's collapse rippled throughout the financial world, raising questions about risk management, transparency, and the regulation of family offices. Part 5. Lessons learned from Archegos Capital's implosion and its impact on the finance industry. The story of Archegos Capital serves as a cautionary tale for investors and financial professionals alike. As we've seen, their aggressive use of leverage and complex financial instruments, combined with a lack of diversification, ultimately led to their downfall. So what can we learn from this financial fiasco? First, it's crucial to recognize the importance of diversification in investing. By concentrating their bets on a few high-flying stocks, Archegos Capital exposed themselves to enormous risk. Had they diversified their investments across different sectors and assets, the blow from Viacom's stock offering might have been softened. Second, the dangers of leverage cannot be underestimated. While it can magnify gains, it can also amplify losses, as Archegos Capital learned the hard way. It's essential for investors to understand the risks associated with leverage and to use it judiciously, if at all. Lastly, transparency and risk management are paramount in the world of finance. The fallout from Archegos Capital's collapse highlighted the need for increased oversight and regulation of family offices and other financial institutions, as well as the importance of robust risk management practices. So what are some things we can learn from this episode? Diversification is key. To mitigate risk, it's essential to diversify your investments across different sectors and asset classes. This can help shield your portfolio from the negative impact of any single event or investment. Understand the risks of leverage. Using leverage can amplify both gains and losses, so it's crucial to understand the risks involved and to use leverage judiciously. Always be aware of your exposure to potential losses and ensure that you can meet any margin requirements that may arise. Prioritize transparency and risk management. The Archegos Capital saga underscores the importance of transparency in financial dealings and robust risk management practices. Whether you're an individual investor or a financial institution, maintaining clear communication and diligently assessing and managing risk is crucial for long-term success. Now, I'd love to hear your thoughts on this fascinating tale. Have you ever experienced a margin call or taken on too much leverage in your investments? What lessons have you learned from your experiences or from watching others make costly mistakes? Share your stories and insights in the comments below. Thanks so much for watching, and let me know what other video topics I should make next.